You can't compare T-bills with REITs as they are different products essentially. Yes, I agree that they are different products essentially. And the first clue is that they have different names. Should retail investors look beyond T-bills for higher yields? T-bills have been riding a hot wave over the past 2 years as rising interest rates elevated demand for yield and stable returns. Investors like the safety of the government-backed fixed income instrument, which carried little to no default risk. But now, the latest 6-month T-bill cut-off yield has dropped to 2.75%, way down from its peak of 4.4% in late 2022. Recently, I wrote about analysts' views that money could flow into the equities markets, such as S-Reits. There was a flurry of opinions online, and some of our readers clearly disagreed. Let's take a closer look. So this first reader says, T-bills are still offering better returns than Sing dollar term deposits. You can't compare T-bills with REITs as they are different products essentially. Looks like we're off to a great start. Genius. Yes, I agree that they are different products essentially, and the first clue is that they have different names. But seriously, this point was made clear in the story. T-bills are backed by the government, and there's close to no risk that the Singapore government will ever default. Right? We know that. We love the government. I'm not saying that T-bills and equities like S-Reits are the same, but where they're similar, and what is relevant for this discussion today, is that they are both yield instruments and they both give us dividends, and that's all we care about. Okay. A simplified way of looking at this is for every $100 you put into T-bills, you're going to get $3 back. That's your yield. It's less than $3 now, in fact. But on the other hand, equities, including REITs, they carry risk. And in some instances, they carry a lot of risk. Right? For every $100 you put into REITs, you're going to get $6 back in distributions. And that's your 6% yield. But here's the thing, there's no guarantee that you're going to get the $100 that you put in, or your so-called capital back. And this is why we talk about the risk premium. With yields for T-bills falling, do the returns from equities make you now go, maybe it's time to take a little risk? So there are a number of things here that we have to look at. No point in buying S-Reits now unless US cut interest rates. Even large property companies like CDL, UOL, CDL, all go south now. Now, it's true, REITs are highly sensitive to interest rates. You can borrow up to 50% of your total property value. When interest rates go up, your finance cost goes up as well, and this eats into your distributions that you can pay out. And because REITs are well liked for distributions, higher interest rates and lower distributions make them unattractive. So I agree, there's no point buying REITs unless interest rates go down. But I have news for you. The US Federal Reserve has cut interest rates since September last year, and interest rates are going down, which is good for the REITs. US President Donald Trump's policies does throw some uncertainty into the pace of interest rates cuts. But market analysts still see anything from 1 to 3 cuts this year. The point is, interest rates have peaked, and for the REITs, this means that things are going to get better. This fella here says I'm deluded. How can REITs be doing well anytime soon? Look at the footfall traffic. F&B businesses collapsing at record rates. So this reader here does have a point. Malls are seeing falling footfalls. F&B businesses are collapsing. Might be true. Yes, we hear news of that all the time. But if you don't like retail malls, the good news is there are many other subsectors you can choose from. You might like data centers to ride the AI boom. Keppel DC REIT in the last year generated total returns of something like 29%. Or perhaps you prefer a bigger REIT with a diversified portfolio of assets. Some retail, some commercial, some offices. CapitaLand Integrated Commercial Trust would have earned you 10% total returns in the last 12 months. But the point is, yes, there are risks. And equities are never safe in the same way T-bills are. But there can be good alternatives. And here we have more experts. Go for our 3 local banks. Dividends, especially DBS that pay out quarterly dividends. In our SGX blue chips, some are paying good dividends. Exclamation mark, exclamation mark. Very excited. And don't forget, CPF is paying 4%. US Treasury bills, more than 4%. Yes, banks good, buy banks. Blue chips are good, buy blue chips. But that's my point. There are opportunities in the market offering better yields than T-bills right now. So, I don't get what's the point of these comments. The banks, the other blue chips on the STI, I love them. The banks are offering yields of close to 5%. Interest rates are going down, but they're still doing well. Why not? Same point. Same point. My favorite, really. If you buy REITs, you become part of the problem causing the high cost of living for everyone. The culprits for the high rents in our malls. Are you sure these are comments from Business Times Facebook, not Mothership? Whether you buy REITs or not, inflation is going to go up. Mall rents are going to go up. Cost of living is going to go up. But here at the Business Times, we believe in buying the winners. I mean, I can understand why readers feel strongly about this. We love safety, and T-bills offer that. But at 3% yield or less now, we are barely beating inflation. We should follow the call from the MAS Review Group and make SGX great again. Make equities great again. So, where does that leave investors now? Analysts from JP Morgan say S-Reits are still under pressure from US dollar strength and elevated US yield. But the risk premium still looks attractive. And meanwhile, a report by DBS points out that young Singaporeans are playing it too safe, too much in fixed income and too little in equities. Is it time to rethink your allocations? And what do you think? Let us know in the comments. Can't wait to do this again, for sure. Love you.